Hello, everyone, and welcome to today's webinar. My name is Ethan Astenay, and I'll be your host for this morning's session, Nicola Wealth Real Estate 2020 Review, making the best of the ups and downs. I would now like to introduce Mark Hanna. Mark is the Managing Director of Real Estate at Nicola Wealth, and he is the founding member of the Real Estate Division, which formed in 2003. Mark has extensive experience in the acquisition, disposition, and leasing of commercial real estate across North America, and we are excited to have him as our guest today. Thanks for joining us today, Mark.
Thank you, Ethan.
Maybe we'll just jump right into it, and I've got a series of questions for you, Mark, related first to the past 12 months. So if it's okay, we're just going to maybe start with how 2020 ended up. So the Q4 reports for our Nicola Wealth Real Estate LPs were recently produced. Can you summarize these?
Sure, happy to do that. These were just sent out recently, and I'm going to address all three. So I'll start with the Canadian Income Fund. The gross asset value is about 1.5 billion in gross asset value, and that includes 65 assets. Our debt leverage is around 44%, which is pretty consistent in prior years. We've been hovering around 40 to 44%. So that's pretty low debt coverage. Our portfolio occupancy is 92 and change percent. Normally it's a little higher, but we've had some new build own projects, which I'll address later, that are coming on stream. So there's always that lease up phase that you get into. But we're still comfortable with that level of occupancy. We've added a lot of great assets in the last year, and including some new build to own projects. The year-end return ended up at 2.4%. We were a little surprised and disappointed that it was at that level. We thought it was going to end up at 5%, but we had a bit of a surprise in December, and it related to a Calgary high-rise apartment building project where the city of Calgary decided to put the tax burden, the property tax burden, onto commercial landlords downtown, which includes our property. And that had a $5 million negative impact to the value. So if that didn't happen, we would have been at 5 for the year. So that was a pretty significant impact. But notwithstanding, rent collection was very strong at 97%. We also have still a component of Alberta properties, which are again getting very close to 100% rent collection, so we're happy with that. But we are not, we're pens down on acquisitions for Alberta at this time. There are some COVID factors that the appraisers are applying, which I can get into a bit later. But the type of assets that we have in the Canadian Fund, it's very diversified, as you can see from this chart, where we have a nice balance of multifamily rental apartment, we have industrial, we have self-storage, we have selected office, we have some seniors independent living, and we have a very few retail properties. For 2021 going forward, we envision a very busy year of acquisitions, probably in that 400 to 500 million range. So that's it for Canada. I'm going to now move to the US Income Fund. This is the largest of all three of our funds. The gross asset value of the US fund is just a little over 2 billion in gross asset value. The debt leverage is 50%, and as I've stated in previous webinars, it has always hovered around 50%. And the reason it's higher than Canada is because we have a higher proportion of multifamily properties, and with those asset classes, you're able to get a higher leverage just because of the nature of that asset class. Our portfolio occupancy is a very healthy 9.4% occupied. We have 92 assets in that portfolio. Our return was 7.4% for the year, which is still, we consider very good, considering the storm that we just went through. Rent collection is a very strong, just under 98%. And the type of assets that are in that portfolio are really, it's a concentration of multifamily, office, and industrial. There's a couple of retail properties. We do expect also 2021 to be a very active year for new acquisitions. While I'm on the US fund, I think I should address the recent events in Texas. As many of our clients know, we have a number of properties in that market. We have 36 multifamily apartment complexes in San Antonio, Dallas, Austin, and Houston. And we also have 2 commercial assets. The 2 commercial assets, because they had backup generators, were basically untouched. They were unaffected. And even though they didn't have many employees working in there, they were unaffected, and they're fully leased. It's ironic that one of our tenants is Geico Insurance, so I'm sure they're busy with insurance claims. The 36 multifamily complexes were impacted, like everybody else in Texas, with this unplanned storm. But we take comfort in the fact that with our partner Venterra, we have the premium standard insurance plan where we are first in line for restoration. So 2 years ago, when we had a similar storm hit Houston, again, we had minimal damage at that time, but we were first in line for any restoration. So we'll be the first to come out of this, and we're going to look fine. So that's why you have insurance, and insurance costs will continue to rise after this event. Moving on to our last and third fund, the Value Add Fund. This fund is really designed as a merchant fund. It's build to sell or repurpose and sell. It works on both sides of the borders. We're now into our 6th year, and the NAV is 362 million. We've got 46 assets. The return for the year was 9.5%, which is decent, but similar to the prior year, the Canadian dollar had a bit of a spike at the end of December, just like 2019, and that had a negative impact on the total return because of our allocation within the US for the value add projects. We have 25% allocation to that market. We expect that the return for the value add fund is going to return back to that 14 to 16% level next year. We expect 2021 to be a very busy year, as we think we're going to be in the 250 million range plus for acquisitions. And the type of assets that we're pursuing in that fund are really multifamily. We've done well by that, and industrial. And there's going to be some the type of other assets that we are pursuing are bulk portfolio of industrial, where we can buy it in bulk and sell it in pieces. We also like the industrial small base strata. We've done very well by that. We've also been building multifamily apartment buildings to sell. There's a huge appetite from especially from Ontario buyers to buy product out west. So there's multiple strategies we have within the Value Add Fund, and we're very excited about the new projects that we have heading into 2021.
Thank you for that, Mark. Great overview. Since rent collection was such a focal point in 2020, can we dig a little bit deeper into that?
So I did talk about it in our last semi-annual update. So rent collection, it was absolutely critical last year to keep our funds functioning normally. It was definitely the #1 question asked last year by all our clients and everybody in the industry. But I would say that has really now dissipated from our standpoint as our funds have stabilized. We were ecstatic that our funds performed well and achieved 97 to 98% rent collection. And even with the minimal rent relief that was required to help out our tenants, we've started to recover most of that rent relief. So it's really remarkable how our funds performed. And I attribute this strong rent collection results to the asset composition and the tenant quality that we had in our portfolio. But I'd be remiss if I didn't also point out that I think a lot of the credit really is owing to our entire Nicola Wealth real estate team, who, in those times back in April, May, June, July, it was all hands on deck, and it was a very challenging period. They rose to the challenge, and I think that played a big part in getting those results.
Thank you for that, Mark. Maybe we can talk a little bit about valuations, and specifically in our Canadian and our US income funds, and how those fared in 2020.
So in 2020, we made a decision. It just happened to coincide with COVID, but we had a plan to change to quarterly valuations versus having a property in annual rotation. And the reason we did that is we wanted to provide more accurate real-time value for our NAV. There's no question that appraisals had an impact on our valuations and the fund return results. As I mentioned before, the appraisers, they adopted what we call the COVID factors, which in addition to your typical tenant improvement allowance and lease up time and leasing fees and turnover, they really doubled that, which is what I call the COVID factors during the COVID period. They wanted to err on the side of conservatism in this uncharted territory. We do expect, and we're already seeing it, these COVID factors to be removed in 2021 as we come through this recovery. And this, as those COVID factors are removed from the valuations, it will definitely have a positive impact on our returns.
Maybe we can switch a little bit to managing cash flows. And this is something that you and I talked about in preparation for this. Did we experience any meaningful redemptions in 2020? And can you talk a little bit about that, Mark?
Yeah, so there's no question when we were heading into April, we didn't know what kind of rent recovery we were going to have. So we sat down right away and did our forecasting for all three funds to understand our cash flow. And we actually implemented 70% rent recovery because we didn't know what we were dealing with. And so to be conservative, we wanted to, look at that assumption versus our typical 98 to 100% rent recovery. What was interesting is that we didn't receive any spike in redemptions, and that's partly because we have a 6-month redemption notice, and our clients are very well capitalized. So they had other liquidity, and they viewed, like we do, our real estate funds as a long-term investment, which is what real estate should be viewed as. Once we finished up 5 months of rent collection from, say, April through to August, we were able to plan, it helped us plan going forward. And those data points signaled to us that it was safe to, turn the taps back on. We had built up a lot of cash during those 5 months that normally we would be deploying. And so that allowed us to get back. So, we planned for the worst and we hoped for the best. And I'm pleased to say that we got through that storm. We're not through it yet, but I feel like our mindset is a lot better today than it was last March and April.
That's great. Thanks for explaining that. Maybe at a high level, when you look back on 2020, what is the key lesson that you and the team learned?
We learned a lot. I think the biggest thing I would have to point to is fund composition. That really mattered, and rent collection exposed real estate like never before on a global basis. Liquidity of assets, that has a big impact on property valuations. Leasability of assets was critical to maintaining a high occupancy and rent collection. The clear winners, which has been well documented, is rental apartment buildings, industrial, self-storage, and flex office. The not so lucky were hotels, certain types of retail, such as enclosed malls. Those ones were the most materially affected. Certain retail actually weathered the storm. So you can't put all retail in one bucket. So retail such as, say, a neighborhood shopping center where you've got your 4 pillars, your food, bank, drug, liquor, those actually did fine. And we're seeing a lot of demand for that product right now. And then power centers as well, strip centers, power centers, those did well. In terms of office, I think the jury is still out. The work from home is getting a lot of press in the paper. My view is that high-rise office buildings, they will be impacted due to the challenge of trying to move all those people, when they come in the morning, they go for their coffee break, they go for lunch, they go home. That's a lot of people to move in those elevators while we're social distancing, and when you can have max 3 to 4 people in an elevator. But I would say, again, you can't put all the types of office into one box, because I would say that low-rise office, like say creative office, 3 or 4 to 5 story buildings where you can still use the stairs, or flex office or single story office, that's going to continue to do well and they're occupied. So we're not, that product is going to be fine. But going forward for us, what we learned is that we're going to focus on the assets that performed well and prepare for the next storm, because there will be one at some point. And that's going to be multifamily apartment, it's industrial, it's self-storage, and flex office. However, I still think there's going to be opportunities for stressed assets, such as retail, but we're going to be very cautious as we go forward on those.
That's very interesting. Thanks, Mark. How did falling interest rates impact our funds, and how did we navigate?
Yeah, so it was the perfect storm because interest rates did come down, so that helped. And so utilizing debt responsibly is really an important ingredient for our funds, and always has been since day one. What it allows us to do is to provide an attractive leverage return to our investors. And as noted earlier, our debt leverage ratio is very low. It's 44% for a Canadian fund, and it's 50% for the US. So that's not high leverage. And as you point out, interest rates are now very attractive, and they're at all-time record lows. So where it's helped us is in a number of areas. It's helped us on new acquisitions, as it provides really a healthy spread between the going in yield, the return on the property, the cash flow return, compared to the interest rate. So ideally, you'd like to have, I'll simplify this, 2 to 3% difference between the interest rate and your yield. And we're able to do that with these low interest rates. These rates have also helped us provide really attractive debt on new construction projects. And it's also been beneficial on our existing portfolio. So as our existing debt has matured, we were able to, we've been doing this over the last 18 months, we've been able to reduce the interest rate by as much as 100 to 150 basis points, so 1 to 1.5%, which is very significant. And at the same time, because we've moved the revenue, the net income up, it's also allowed us to recapitalize the asset and take out more income and redeploy it into new assets. So what's happened with this whole COVID environment we're in is that lenders have become very selective with borrowers. And that is where our track record and our portfolio size makes us very attractive.
Maybe we can pivot a little bit. We've talked about the importance of cash flow on performance. How about leasing? Why is leasing important, and how does it impact performance?
Well, leasing is critical, and that's why I've really geared up our Nicola Wealth real estate team with some leasing experts to provide a lot of horsepower. Cash flow, it underpins the thesis behind real estate investing. So leasing is absolutely critical, especially after this COVID storm, which is not over. It's played a critical role in the overall performance of our funds. This is something we deal with every day with our team, with our entire portfolio, trying to retain tenants, grow the revenue. Landlords and buyers of real estate, they also will want to know going forward how those tenants performed during COVID when you're acquiring a property. Did they require rent relief? How did they behave? So those are going to be really important things when we're looking to acquire a new asset. When we look at the tenant role, there's going to be a lot more scrutiny because owners are going to be laser focused on the tenant's covenant, their past behavior. And so I think there's going to, a much deeper dive on due diligence on the tenants.
With respect to acquisitions, maybe you can let us know what the team is planning and what we see for 2021.
So as mentioned earlier, we hit the pause button last April. We needed to take stock of our portfolio, and we needed to see how our assets were performing. It would be irresponsible to go out there and keep spending. And I think everybody pretty much adopted that same policy. They just wanted to really focus on rent collection, which is what everybody did. So once we had, and maybe we were sooner back to the table, but once we had sort of 5 months of data points confirming that we had strong rent collection and that our assets were standing up and our portfolio was solid, we decided to jump back in the deep end of the pool in August, because we felt, okay, let's go, because we have all this cash and there's opportunities. And so actually what's interesting is that we're actually seeing a higher volume of opportunities, and we're actually seeing better quality assets than pre-COVID levels. And my only explanation for that is that I think there's still a lot of buyers, private, institutional, that are perhaps handcuffed due to their existing portfolio by the nature of their composition. Maybe it's because they have too many hotels, or they have too many enclosed malls, or what have you. So I think that's certainly really helped us. So in 2020, we actually completed 625 million in transactions, which is truly amazing considering we took 5 to 6 months off. And when you compare that to the previous year, which was a record year for us in 2019, we did over 825 million. So it wasn't, in the last 4 or 5 months of last year, we were very busy. And then going forward into this year, into 2021, our pipeline is very full. We had a lot of deals that have carried over, that are under contract and subjects getting waived. I could see us easily surpassing $1 billion in acquisitions in this year.
Impressive. Maybe we can talk a little bit, and we've discussed this in the past, build to own as a strategy within our income pools. And maybe can you comment about what specific asset classes this might apply to?
So the build to own is something that this strategy we've talked about for a long time. And we finally made that decision a couple of years ago that we need to do this. And we realized that it would be very challenging to pay full retail for new and shiny product and make those acquisitions accretive and positive for the returns in our fund. So we made a decision to pursue these build to own, but we also needed to bring in the expertise in house. So we've built that team internally to pursue these build to own opportunities. And what it does is by doing the build to own, and we're only going to have a certain component of our fund that's in active build to own at one time, but it allows us to build to a better yield of 5% or greater, and it also provides a much higher return on cost in the mid-teens. And we couldn't achieve these results if we were to buy new product at full retail from somebody else who would then get the profit. So going forward, the build to own will continue to play a really important role in the growth of our income funds for new assets, especially for multifamily, industrial, self-storage, and even certain types of office, like flex office. So we got a couple examples that we maybe can share with our audience. One is in Toronto, in Mississauga, and it's 880 Avonhead. And this is not the greatest picture, but it's 300,000 square feet distribution center. It's just finishing up now. And what's interesting in Toronto is in a full lockdown environment, construction sites have still continued. That was one of my biggest concerns when COVID unfolded, was would construction sites stop? And they've actually kept going, even in Toronto, where it's a full lockdown. So this building's just finishing up now. This is probably from a month and a half ago. So it's finished. And we have 3 tenants that want to lease the entire building. So we're just very close to inking the deal with a very high profile tenant. And all 3 were great tenants. And the interesting thing is, when we underwrote this build to own 2 years ago, we thought we were going to get rents of $750 net. We were being conservative. They're going to be close to 10 net, because we're also riding the wave of the industrial growth that's very strong in certain markets such as Vancouver and Toronto. So this one's going to do very well for us, and this is another example of why you want to have build to own, and we plan to keep this for a long time. It's a fantastic asset. I have one other example that I want to share, and this is more of a strategy that we have. If we can go to that. So this is also in Toronto. We like buying what we call covered land plays. So we bought this from Tim Hortons, and this used to be the Tim Horton head office and their test kitchen and a drive-through. So the two buildings in the front is the drive-through and the test kitchen. Those have stayed there, and Tim Hortons leased those back for a long term. But the building in the back, they wanted to move that operation closer to downtown. And this is in Oakville. So we tied this property up, and it was conditional upon putting another tenant in here, which we completed this transaction a year ago, who are an excellent covenant. It's online teaching, and they signed a long-term lease. So the reason we like this is it's 11 acres in Oakville. There's a higher and better calling for this property down the road. But for now, we've got a fantastic leverage return, and we'll start planning what the next evolution of this property is in a few years from now. But in the meantime, we can enjoy that income on this property. So this is categorized as office, but it's single story, low risk, and there's a higher and better use with that 11 acres down the road.
Thank you. Those are great examples, and it's nice to see them, Mark. Maybe we can talk a little bit about the U.S. election. Now that we've got the outcome, how does this impact the strategy for us?
So we often get this question, and I get asked, does it matter if it's a Republican or a Democrat in the White House? And my answer is no, it does not matter. Although I'm personally happy that we have a good human being in the White House right now. However, there is no question that we do have a very specific focus on certain cities or states that are either tax friendly or they feature strong business growth. Some of these examples of those cities or states would be, say, Seattle, Phoenix, Denver, Las Vegas, for our commercial assets, because they're either very pro-business or they're tax friendly. And then from the residential side, Texas, Florida, South Carolina, Tennessee, the right to work states, those are also very tax friendly. So we focus on those states in particular. We do have a more focused strategy in the US, which is currently centered on multifamily rental apartment with our partner Venterra. That includes a lot of garden style gated communities and now some mid-rise urban developments. As well, we like, for our commercial assets, industrial distribution in the primary nodes, and even covered land plays where there's maybe a higher calling, as per the example I gave for the Canadian fund. So we have a couple examples here that maybe we can show our audience here. So would be start with the district building in Seattle. So this is what I would call a covered land play. So this is very close to, well, very close to the I-5, but it's very close to the University of Washington campus, and it's in, call it University Town. So we bought this 6-story old concrete building. It was all leased to spin-off tenants from University of Washington. Well, we didn't buy it because it was a 6-story office building. We bought it because it was the transit LRT is being built right now in Seattle, which is going to be a game changer. So this is like 2 short blocks, if that, from the new transit station. And our plan is and this building is currently 60 feet. We can build 300 feet, similar to that big building sort of to the left of it. And we're going to build a residential rental apartment building on that site. So again, this is a great example of a covered land play. We have one other example for the US, and this would be, if we can go to the next slide. So if you can see in the inset picture, it's scrappy industrial. This is in the Deer Valley, North Phoenix area by the 101 loop. It's in a very prime industrial area, and that is experiencing a tremendous amount of growth. So we bought this land a year and a half ago, and it had a lot of land users, which had short-term leases. But again, we knew there was a higher and better use. And so you can see now in the picture, we've designed in our build-to-own strategy to build traditional industrial buildings for small to mid-bay users in the marketplace. So that is now just going to be starting construction very shortly. And again, this will be great product to have in our income fund.
Thanks for that. So maybe we can pivot to the value add development fund, which is now 6 years old, and we have over 50 properties. So has the strategy for this fund changed over time? And maybe can you tell us a little bit about that?
So you're right, the strategy has changed. We are in the 6th year, so it's now maturing, and it's developed a solid track record. I would say at the beginning, back in 2015, late 2014 when we started, that fund really benefited from a lot of great tailwinds. And so we got some really strong returns. And then what happened in around 2018 is we noticed that the costs started to rise, permits took longer. So there's a lot more stress on the delivery date because this fund is benchmarked on the IRR, meaning how long does it take to complete the project. So it's challenging for us to acquire lands that will take 2 years to put into production. We just can't do that. We can't wait that long. So we got to find closer to shovel-ready sites. However, our strategy has changed slightly, where what we are now focusing on is very specific projects that have done well. So for example, if we can show, I think we have a slide here. We have, I'll just talk about the asset types and then I'll talk about this. So the kind of strategies that we are focused on is small bay industrial strata condo, which is this picture, and I'll come back to it. Building industrial buildings mid-bay for lease and then selling the building to an investor. We're doing one of those in Chandler and Phoenix. Multifamily rental apartment buildings, building those and then selling them. And buying an industrial building in bulk, which we're doing in Toronto, and selling the pieces. We also have another strategy of really land and density entitlement. So if I can go back to the previous picture. So this project is one of our very strong brands called Interurban. And so this is in Burnaby. This just was completed in December. It was basically 100% pre-sold before we even started construction. And so it took about a year to build, actually less than that. And so we're on to our 15th project, I think 10 of them with PC Urban, and then we've got some other partners we've done the similar strategy with. But the Interurban brand has really become known and popular in the marketplace, and we're doing these in Vancouver, Kelowna, Victoria. Eventually want to do it in Toronto, but this is really for the small business owner, the pool guy, the construction guy, the concrete guy, who can buy his own little 3,000 square foot unit, or he can buy 3 units and have 10,000 feet. And it's an easy commodity for you to sell if you ever want to do that down the road. But this is a very popular product because it's challenging for those business owners to buy their own property that's modern. It just doesn't exist because of the constrained market for industrial. The other example that I have for our value add fund is on the next slide, is where we build apartment buildings and then sell them. And in this case, this is in Kelowna, which is experiencing tremendous growth. We built 2 twin buildings here. They were 100% leased within, they completed in December. So they were leased, I think they were pre-leased before as the building's finished. And then we sold this to a Vancouver buyer who's very happy with this asset. So these are the kind of projects that we're doing in the value add fund where we know there's good liquidity and strong demand for the end buyer.
thanks for giving those examples as well, Mark. There's so much going on in our real estate management efforts. How do our investors and those who are interested stay informed about what we're up to?
Well, we've made a concentrated effort over the since COVID really, to try and provide even a higher level of communication for our clients. So, we've always done our quarterly reports, but we're doing newsletters, we've done podcasts, we publish recent announcements on acquisitions or noteworthy milestones, and then of course these webinars. And so probably the best place to start is at our nicolawealth.com website. There's also a link to our real estate as well there, but that's probably the best place to start, where you can see all the latest information, and where all our team is posting on LinkedIn as well. So we're reaching quite a large audience with our communication.
Lots of material, and thank you for that. We're going to begin answering some of the questions that have been submitted during the presentation. And as a reminder to our viewers, you can still submit through the Q&A feature at the bottom of your screen. So, Mark, our first question, there's a lot of uncertainty about office real estate. What's your perspective? Can you share your insights? And how does this impact Nicola's funds?
So the office product is, it is in the press a lot, and but more than any other asset right now. I mean, obviously hotels I've talked about, and those have been impacted, but there's a lot of uncertainty on office, and this work from home is I have a very strong opinion on this topic. And if you look at our real estate team, which is 35 people, we're in the office every day. Like, some are doing shift and they're coming in maybe 3 days a week, but it's busy. Our team is here, and we've been here for a number of months, going back into the summer, and they want to be here because that's how we work. We collaborate. And I would say the entire real estate industry, mortgage brokers, real estate brokers, developers, or investors like us, we're all back in the office. Like, it's like as normal as it can be but we're wearing masks. So I think this whole work from home is overplayed. I think it's too early to call the death knell for office. And I think, as I said earlier, there are certain types of office. You got to really break down that category. So high-rise office tower, probably going to be the most challenging, because you got to move all those people in elevators. But the low-rise buildings, or the single story, or the flex, I think they're going to be fine, because you can move people, it's safe, and it's really about safety. And what I see with office buildings, we're going to go through a seismic shift where owners of existing buildings and new buildings, they're going to have to implement what I call these COVID safe features. It could be touchless entry with a fob. It could be hand washing. It could be your air conditioning system as certain filter. I mean, all these things are obvious, but they're going to have to be implemented by certainly office buildings and hotels and shopping centers, but definitely office buildings, because there's such a mass concentration of people. So I'm not a believer that the office is dead. We don't own high-rise office towers, so I feel good about that, but I think it's too early to make that call.
Thanks for sharing those insights. The next question, what is Nicola Wealth's view on real estate investing in the various asset classes in Calgary and Edmonton?
We're not buying there. I mean, I wish we could, because when you look at a map of Canada, it's skinny. I mean, we only have a few choices. I've got Toronto, which we're very, very active in right now. We got Vancouver, and then Victoria and Kelowna, and we're looking at Ottawa right now. We have a few assets in Winnipeg, but it's a skinny list of options. And all of us want Alberta to come back, and we want to be able to acquire. But until they can figure out what their economy is, and they're not so reliant on oil, and it's going to be a while before people have confidence. There are some contrarians that are going in there and making they're buying office and they're buying industrial. So, but I think right now we're just hit the pause on Alberta. And yet people are still call us wanting to buy our assets in Alberta at prices that meet our NAV. So we're comfortable because we're collecting rent, but I just can't go forward buying properties in that market yet. I don't want to be the first in. I got to see some evidence that that economy is turning around, and they need to find something new other than just oil. I don't know what that is, solar, but it's got to be something other than oil.
Thanks, Mark. The next question, funny, you said the word contrarian, and the next question is, are there any contrarian investment opportunities being considered, such as retail shopping centers or hotels?
Don't think we're ready to jump in on hotels unless you can convert it to an apartment building, which we did with Harbour Towers in Victoria very successfully. But I would say retail, there could be some opportunities. And what's interesting is because the popular asset types like apartment buildings and industrial and even self-storage, because they're so attractive and they through this COVID environment, there's a lot of people flocking to that asset type. So what it does, it drives down the yields. Now, we need to be very selective on what we buy, and we've got to try and find those off-market deals that are accretive to our funds. But what's interesting is the demand that we're seeing for retail, and we just sold one of our retail centers at a above our NAV, so we were fine to do that. But we're seeing a lot of groups showing interest in retail, both in the US and Canada. And the only conclusion I have is that because there's so much focus on these other asset types that I mentioned and the yields are lower, people are saying, well, why wouldn't we buy a neighborhood shopping center or a power center? They're collecting all their rent and the tenants are fine. They're performing. So, and we can get a yield of that's 200 or 300 basis points better than those industrial and apartment building assets. So I think that's part of it. The enclosed shopping centers, that one's going to be interesting. They're going to need to redefine and attract new users to the mall. Even though a mall is open right now, it's quite possible that some of those tenants, even though they're open, they might not be paying rent or they have rent relief. So some aren't going to make it, and it's unfortunate. And those enclosed malls, there will be an opportunity. Don't know what it is yet, but they're going to need to redefine themselves. But yes, I do think there are going to be some contrarian opportunities, and we're always looking at those all the time.
Thank you for that. The next question, how has the self-storage asset class performed throughout the pandemic, and what are your views going forward?
Well, we love self-storage. I mean, it's our second asset we bought when we started the funds way back in 2005, and we started with 4, and now we're up to 6. We made a big move recently, and we acquired really a new management team that came from another major competitor. And so the reason we did that is we wanted to have the right team in place to position us for growth, because as you point out, self-storage, it's made it through the storm. And when COVID rolled out, it would be natural to think, okay, people are going to be concerned, they're going to have fear, they're going to cut costs, they're going to, cancel their locker. That didn't happen. And in fact, not only did they maintain their occupancy, but what with this increase in the residential market, that's where self-storage benefits. When the residential market is strong, people need to store things because they're moving to smaller, or they're just moving. And so that really has benefited us, especially in the last 6 months. So we like that asset class. It's a very tough market to get into. It's an operating business. So it's not just the real estate, but it's the team in place. So we have 6, and we see ourselves growing that to, I'd like to get up to 20 to 25 of those in Canada, because it's such a great performing asset, and we have the team to do it, to run these properties.
Thanks, Mark. If you could make sure one of those is near my house, that'd be great. I'd feel better about paying that.
We'll give you a good deal. You just use my name.
Thank
Yeah.
Good. Really good question just came in. What is Nicola Wealth's strategy on sustainability when acquiring and developing properties?
Can you say that again?
What is Nicola Wealth's strategy on sustainability when acquiring and developing properties? And so I think this just might mean perhaps sustainability as it relates to the development or the construction.
Well, we definitely look at that. We want to look at for the long term if we're building, and we want to make sure it lasts long. I mean, we're looking at even the types of materials we're using. I mean, there's a lot of talk about mass timber and that's popular. So yeah, that's a big focus right now is materials. So we want it to last, and we want to make sure that we can minimize the capital expenditures you're going to have in the life of the project. So, but the materials is going to continue to be a very important topic from whether it's office or any type of asset that you're building. So yeah, it's definitely front and center for our team.
The next question relates to financing. When you are refinancing existing assets, do you typically get a new loan based on the existing mortgage balance, or do you try to increase the loan amount based on the current value of the property?
Well, no, hopefully the value has gone up because over the life, typically we do a 5-year term on a mortgage, and hopefully over that time, which typically happens, we've increased the revenue on the property, so the income's higher. But on renewals, we run a process. We do have some preferred lenders and that are very good to us. So we do give them first shot at trying to keep the loan, and we obviously provide them with the updated information on the property. And if they can be competitive on the rates and the higher amount of the loan, then we look at it. But we always want to run a process because we want to have something in the file for each property to show that we ran it. We talk to lenders, we do a long list, a short list, and we have a gentleman on our team that we hired from Coast Capital who runs our entire mortgage portfolio for our real estate. And I think that process is important to make sure it keeps everybody honest and we get the best financial terms for our investors. So it's very rare that we'd re-up with the same lender. We might renew with a lender, but we would still run the process.
The next question is specific to Canada. Are there any other markets in Canada you are considering with such a competitive landscape in Toronto and Vancouver?
Yes, that's a good question. And Ottawa, we're looking at very closely right now. We've got a couple opportunities we're doing. We like multifamily in that market, and we like industrial. We've got some things in the pipeline right now. We would consider some smaller markets in Ontario. So similar to how Victoria and Vancouver work together, we could look at Guelph and London, which are near Toronto. We haven't gone there yet, so those are strong markets, good university towns. Montreal is a market we'd like to get into. That's more challenging. We want to make sure we probably best to get in with a partner, so we don't. It's different just with the culture and the language, and it's definitely a little bit more tricky, that market. So we want to, we'd like to get into there. But I think the first step for us beyond Toronto and Vancouver is Ottawa, which we'd like to do. I mentioned earlier about Winnipeg. We still like Winnipeg for, say, industrial, but again, that's a smaller market. But even though we are in Vancouver and Toronto, and I know they're expensive, it still has great leasing demand and great liquidity. So it doesn't bother us that we're heavy in those two cities.
They keep coming in, Mark, so we're going to keep.
I thought I answered all their questions with my presentation.
So the next one is, what are your plans for seniors housing going forward? Okay,
so we have 5. So 4 are with our partner Century Group that are in Vancouver, in Langley and Tsawwassen. And we have 1 in Nanaimo with another operator. I got to say, both Origin, which is Nanaimo, and the Century Group, which is the 4 here, they did a remarkable job during COVID. The first thing that I thought of when this whole virus was unfolding was keeping the seniors safe, and just the measures they had to implement to do that, because that was such a high concern. And I'm happy to say that we've made it through. We're not through, but they made it through. And hopefully a lot of our residents and staff are going to be getting their COVID shot either now or very, very soon. And so, but they managed to keep them safe. So we like that asset type. However, we did put the pause on those during, since COVID. And we would consider buying more, but we wanted to just wait and get through the COVID storm and make sure everybody's safe, because that one probably is a little bit more susceptible to, it's not like an apartment building where it's easy to replace tenants. It's tougher with the senior. So we like that asset type, but we got the pause button on. They're performing great. The occupancy is very high in the mid 90s. And I give that credit to our two partners.
Thank you. Another good question. How do you decide if you're going to sell a property? A simple question, Mark.
We don't sell that often, because when you sell, there's a couple of things. One, you pay tax, and there's you got to redeploy those funds, and we already have a lot of capital, so we're not looking to sell in our income funds. The rationale that we use is there's a couple of things. One is, as we've grown, we change our investment criteria in terms of whether it's a market or an asset type. And so I'll give you two examples of recent decisions. One is Lougheed Center in Coquitlam. It was retail, and we're not super big on retail. We've did everything we can. We released it out. It's performed well, but an offer came in at higher than our NAV. So we thought, okay, it's accretive. Let's sell. We can redeploy it. So we made that decision, and that property is firm, and it closes shortly to a private buyer. So that was a good outcome. We had another building in a suburb of Seattle, in Bothell, and it was a single tenant, pretty much, with a healthcare tenant. And we had an unsolicited offer come in for the whole building, again, at higher than our NAV. And we wouldn't buy either of those properties today. I'm not sure we would go buy Coquitlam Supercenter, and I'm not sure we would go buy this one in Bothell, because it's single tenant. So part of the rationale is, would I buy that property today? Because I could sell every property in our portfolio if I wanted to, because we get asked all the time by brokers, would you sell? Would you sell? So my main first question we ask ourselves is, would we buy that property today, regardless of price? Would we buy it? Is that an asset we'd like to buy? And if the answer is yes, we wouldn't sell it. If the answer is no, we wouldn't buy it, then then we go on to the next. Okay, does it meet our price? Is it accretive? That's how we look at it, but we don't sell that often.
Thank you, Mark. And thank you everyone for attending today's webinar. Nicola Wealth Real Estate 2020 Review, making the best of the ups and the downs. If you have any other questions, please contact webinar@nicolawealth.com. On behalf of Nicola Wealth and our presenter, Mark, thank you for joining us today, and have a great rest of your day.